Do you own PayPal stock? That's a question we are going to tackle today, Fortune Fastlaner. What a great day to start our discussion. For today's video, we are going to talk about everything that happened to PayPal. Buckle up and we will now commence with our journey. We are Fortune Fastlane and we are going to give you what you need to know. We've been assisting people in learning about money, personal finance, and investment. If you want to improve your financial future, subscribe to the channel and hit the like button. This video will be beneficial to you, and if you find it life-changing, ping that notification bell for your convenience. Whenever we post an update, you'll be the first one to know. Now let's get into it, shall we? After the closing bell on February 1, 2022, the next day, PayPal's Chief Financial Officer John Rainey said that investors should be more concerned about the company's short-term future because of a range of obstacles and concerns. Normally, such a statement would result in a 5% to 7% decrease in the stock price after hours. But PayPal's stock price plummeted 18% after hours. Clearly, officials and investors were hoping that the next trading day would be much kinder to PayPal and that the panic would diminish. But on February 2, losses only continued to snowball, and PayPal would wind up having their worst trading day ever, suffering a terrible 24% loss. Since then, PayPal has continued to suffer, with its stock dropping by a total of 30%. Obviously, this decrease in and of itself would be deemed a bear market, given that the sell-off is greater than 20%. But this is only the most recent in a string of losses for PayPal. Since the end of July, the stock of PayPal has dropped by a total of 60%, resulting in a market capitalization of more than $200 billion and a loss of more than $200 billion. Clearly, the stock of PayPal is in the midst of a mini depression. So what happened to PayPal and why was it closed? Getting out of trouble. When we look back, one of the most significant shortcomings of people was that they were never able to establish a financially viable enterprise on their own. PayPal, like many other businesses, struggled to make a profit in the early stages of their existence. In spite of this, they had millions of clients thanks to the rapid adoption of the internet. As a result, focusing on consumers rather than earnings was totally acceptable throughout the latter part of the 1990s. When the dot-com bubble burst at the turn of the 2000s, it was relatively simple to raise capital, especially for a rapidly growing fintech business. However, this would all change with the collapse of the financial sector. At the time, it was obvious that PayPal needed to focus on profitability if they were to survive. However, PayPal CEO Elon Musk appeared to be preoccupied, and Elon wanted to expand PayPal into a comprehensive financial platform and switch their servers from Linux to Microsoft. While these objectives may have been in the best interests of the company in the long run, the other executives believed that Elon was losing sight of the company's primary goal, which was to make a profit. As a result, when Elon was away on vacation, the decision was made to terminate him and replace him with Peter Thiel as CEO. The company's focus was turned in the proper direction as a result of this, but they still had a long way to go. eBay had announced a deal with Wells Fargo to build their own in-house payment system dubbed the Bill Point. Considering that eBay accounted for 61% of PayPal's revenue, this was not a favorable development. This excessive reliance on eBay was in fact the key reason why both Google and Yahoo declined to acquire PayPal. The only firm interested in acquiring PayPal was eBay, but they made a predatory offer. They offered $400 million and stated, quote, "We are going to make this offer once and then smash you, so you should absolutely take this offer." PayPal declined the offer. Taking this into consideration, Peter decided to throw a Hail Mary by going public with PayPal in February of 2002. If this had happened only a few years earlier, it would have been easy easy money, but it happened at the height of the dot-com bubble, and investors were exceedingly cautious. Nonetheless, PayPal was valued at $1.2 billion in the initial public offering, which only goes to illustrate how predatory eBay's initial offer was. In the wake of this, eBay knew that they had lost the bidding battle, but they did not want to lose PayPal as well, so they made a far more reasonable $1.5 billion offer to Peter, who, given PayPal's dire financial situation, chose to just accept the offer and sell his company. Peter had successfully guarded PayPal against a predatory purchase, but he had failed to preserve the company from its dependency problem, which would only worsen over the next decade now that eBay had taken ownership of PayPal. Principles of golden chains. Despite the fact that the acquisition resulted in an unhealthy reliance on eBay, the deal was extremely advantageous in the short run. The fact that eBay was able to absorb their losses virtually instantly effectively eliminated PayPal's profitability difficulties. A similar point, now that PayPal and eBay were no longer competitors, there was no prospect of eBay discontinuing support for PayPal, allowing PayPal to concentrate on expansion once more, which was a pretty straightforward process. They essentially had the entire eBay marketplace to contend with, but at the same time, their potential was severely limited. Venmo's meteoric ascent to prominence is a fantastic illustration of this. Venmo wasn't created until 2009, more than a decade after PayPal, yet they have risen to become the dominant player in the peer-to-peer payment business. Venmo has gotten so popular that the word Venmo has become a verb, similar to the word Google. Square was yet another excellent illustration of PayPal's stagnation. Square was launched in 2009 as a straightforward financial services company, but today the company is worth $60 billion on its own merits. Normally, you would expect PayPal to have a significant advance to have destroyed Venmo and Square, but under eBay, this was not the case. To be clear, this does not imply that PayPal was having a poor year. With over 100 million active members in 2011, they were seeing tremendous growth in their own tiny bubble of success. In other words, PayPal's stagnation was caused by their inability to expand, rather than a lack of growth in their own sector. Such expansion initiatives were critical to the company's evolution into a diversified financial services company, but instead it was all tucked away under the golden chains of eBay. However, PayPal wasn't the only company that was being hampered by the actions of the other. As you can see, it wasn't particularly advantageous for eBay to keep PayPal around, as there was little synergy between the two companies. Yes, PayPal granted eBay authority over payments on the platform. However, in order to obtain this power, eBay was required to support PayPal in its non-eBay related business activities, as well as their eBay-connected business endeavors. Taking PayPal as an example, the company noticed that it was losing ground in the peer-to-peer sector in 2013, and so it opted to acquire Braintree or Venmo for $800 million. This was a fantastic acquisition for PayPal, but guess who was on the hook for the money? It's not that eBay didn't want PayPal to be successful. It's just that the two companies didn't have much in common. In order for a partnership to be successful, it must be possible to share resources while keeping expenditures to a minimum. For example, when Facebook acquired Instagram, the company already had a large number of app developers and social media experts on staff, allowing the two companies to easily share resources. However, eBay did not have a large number of financial analysts and credit card experts on staff when it acquired Instagram. So, from eBay's perspective, it felt like they were burdened with the responsibility of running an entire separate company when all they wanted was an integrated payment platform. And as time went on, it became increasingly clear that it was best for both companies if the two companies parted ways. The art of exiting eBay. When eBay announced that they will be spinning out PayPal into their own corporation once more in late 2014, the world reacted with excitement. Initially, the business planned to go public click on the NASDAQ. Annexing eBay shareholders will get 1 share of PayPal for every share of eBay they owned at that time. Aside from that, eBay has indicated that they would continue to cooperate with PayPal until 2020, after which they will transition to Adyen for payment processing services. They have, however, said that they will continue to support PayPal as a payment method until July of 2023. Because of this extended time frame, PayPal had ample opportunity to expand their business outside of eBay, and this time around it was significantly easier than their last attempt in the early 2000s. PayPal was a well-established and well-trusted brand by this point, which made it much easier for them to attract new online businesses to their platform. On top of that, PayPal had finally achieved profitability, allowing them to stop worrying about raising further funds on a continual basis. Instead, they might utilize their profits to acquire additional businesses, which is exactly what they did. PayPal has completed a total of 12 acquisitions since 2016, with the most well-known of these being iZet and Honey. It wasn't all smooth sailing, however. The draft terms of service were released just before PayPal's separation from eBay in mid-2015, and one section of the TOS in particular attracted people's attention. PayPal's terms of service stated that the company had the right to robocall and auto-text consumers at any time, and that if customers did not agree to this, they would be compelled to delete their accounts. To make matters worse, PayPal had just said a $25 million punishment for dishonest business practices, which further complicated the situation. Consequently, the last thing they needed right before their IPO was another public relations disaster. Although PayPal eventually resolved its challenges, the company was only able to quadruple its yearly revenue from approximately $1 billion to $2 billion over the next couple of years. The major boom, however, didn't occur until 2020, when the pandemic struck in the United States. According to what you might expect, when people were confined to their homes, they were significantly more likely to use online-based financial services than they were to use traditional financial services. People were also spending significantly more money online, which only served to boost PayPal's growth even faster. Despite all of this expansion, however, expectations grew even higher, and PayPal quickly found itself unable to live up to the expectations of the public. Expectations that failed to meet their goals. As soon as the pandemic began, investors raced to technology companies in search of a safe haven. They resigned from their positions at airlines, restaurants, and hotels, and all of that money poured into the technology sector. This resulted in one of the most explosive runs in the history of PayPal. PayPal stock soared from its epidemic low to a whooping 244% in the next 12 months, 760% return from the initial public offering, or an 8.6-time return. But the problem was that PayPal's bottom line had only risen by around 5 times, implying that PayPal was overpriced by 72% when compared to their original offering price. To make matters worse, PayPal's net income was beginning to plateau at approximately $5 billion. And when investors began to realize that they may have given PayPal a little too much credit and that the company was comparatively overvalued, they began to sell their shares. This sell-off did not only harm PayPal, but also other financial institutions. Incredibly, investors had pushed up the prices of all stay-at-home stocks beyond imagination, and they were now cashing out at an alarming rate. By the beginning of 2020, PayPal's shares had already fallen by almost 40%, and the company's dismal guidance had sealed the company's fate. Looking back, PayPal's rocky history was never their fault, as they have stated. It was virtually always owing to the circumstances in which they found themselves. PayPal initially struggled to stay solvent during the financial crunch that followed the dot-com bubbles deflating. This compelled them to join eBay, where they were mostly trapped in the eBay marketplace bubble for more than a decade. After eventually breaking free from eBay, they had to spend years diversifying and establishing a business that was not completely dependent on eBay. Unfortunately, just as they were able to break free from eBay's golden chains, they became entangled in the tech bubble that erupted following the COVID crash. One thing that has stayed constant despite all of the failures and obstacles is PayPal's tenacity, and we don't believe that has changed. In fact, we believe that a large number of investors are currently dozing off on PayPal stock. The announcement that Amazon will begin accepting Venmo payments in 2022 came just a few months ago from PayPal. Now, personally, we believe that using Venmo to pay for things on Amazon is a waste of time when one might be earning cash back or incentives by using a credit card instead. But regardless of what we think or what we believe to be the most prudent financial decision, we are confident that Venmo will be widely used on Amazon. And even if PayPal only captures a couple of % of Amazon's marketplace, we are talking about tens of billions of dollars worth of transactions every year. On top of that, we believe it is highly likely that people who became accustomed to PayPal services during the pandemic will simply continue to use them more after the pandemic, whenever that may be. As a result, we believe it is only a matter of time before PayPal transitions from a year or two of stagnation to a decade of growth. But this is only our opinion and does not constitute financial advice. Do you guys have a PayPal account? And if so, what exactly do you want to use it for? Please share your thoughts in the comment section below. Also, if you believe that PayPal's resurgence is unavoidable, please click like, as well as checking out our international channels to see your films in other languages, and considering subscribing to see more questions logically answered. But for the time being, I'm going to leave you to your own devices. I'll see you on the next one, Fortune Fastlaner. I promise.